So, Ian, obviously a very exciting time for Afentra. You signed the deals in April, I believe, and you're sort of moving towards completion. What drew you to Angola?
I think there's a few things that really drew us there, in that it's been the purview of the majors. If you'd asked us 10 years ago, should we have been in Angola, there wasn't a space for a small company. Now, with the countries recognising that the majors are going to be moving on in 10 years' time, probably in the ultra deep water, the LNG, but the shallower water areas, maybe what we call the baby deep water, there'll be new players in there, and they need new investment. And we look at it as the story from the North Sea or the Gulf of Mexico that's been playing over 25 years will happen in Africa, but specifically in Angola, you've got huge opportunity, limited competition, so we don't see many other small independent players, and with where our background, with the responsibility, with the track record and the finance side, you can go in and identify some really good assets.
Angola has long been a sort of it's been a tough environment, very much sort of the area of the majors, the sort of the deep pocketed companies. How can you, as a sort of a relatively small company with not much sort of history behind you as a company, although obviously you as a group of people have experience, what can you bring to Angola that sort of makes it work?
So where we look to play is where in the shallower water aspects. It's all in the production side, production development. The assets there have really been there hasn't been a lot of investment in them. They've been continued to do workovers, but not infill drilling. So you're taking on assets or working with Sonangol to join in the assets, which have got actually an incredible amount of running room. So what we bring to it, well, there's the financial side, that we're well supported. The technical side, we've got the experience from working up and down West Africa and East Africa in these type of assets, partnered with smaller companies as well, or Perenco, M&P. So we've seen and we've learned, and we do ourselves how to run those assets and invest in them. Operationally, we look at it. And then the other side that we're really looking at is how to improve the emissions profile of the assets. So at the moment, if I use B305 as an example, although we're doing the due diligence from a technical, financial side and operational, the other component is with a company looking at the emissions and the environment from effectively the ESG side. What can we've got a number of ideas, but what can they look at from the asset, and then how can we speak to the partners and look at how can we improve it.
You mentioned financing there, and I think obviously there are big questions around financing in the industry. I mean, obviously now oil prices are sort of past the $100 barrel mark. Things are looking much better than they were last year. But I mean, does that make it easier? I mean, speaking to financiers, there's very much a sort of a question of they see this sort of the opportunity, but at the same time there is clearly sort of societal pressure on banks, financiers, whoever, to sort of move away from fossil fuels. So how do you navigate that as a small company?
I mean, financing, a couple of years ago, as we hit sub $30 a barrel, or even went negative in the US, it was incredibly difficult. Since then, there has, as oil price recovered, there's been more enthusiasm to come in. Will we see a return to 10 years ago where you had a plethora of banks available to fund? I don't think that's the case. But in its place, you've got the traders who are prepared to put financing together. The Arctic bond, the Nordic bond market is available. So there is financing there. What you have to be, I think, you have to look a lot harder. And you also have to be, I don't think there's the financing there necessarily for exploration. There has been some companies that have been successful, but it's not in the scale of the past. Our model is very much production, cash flow, managing the asset round through cash flow. And when you put it like that, there is investment for that.
I mean, obviously, you know, I'm sure that you're going to be fairly busy for the next sort of 6 months or so working through this Angola deal. But once that's kind of up and running, where do you think might you go next?
There's so much running room in Angola as it is, but we've been screening the whole of West Africa, not the deep water. It really is more about looking at the capex profile, the shallower water onshore. So we're active all the way up and down the margin. Angola is the first deal through. There's plenty of running room in Angola. So I don't think we'll be waiting 6 months. There's still plenty of processes. I mean, the whole model of Afentra, when we set it up last year, was we felt there was a wave coming, and that wave of divestment from the majors is translating from what we felt was going to be happening to actually happening at the moment. So there's plenty of opportunities. I think then it's about getting the right opportunities.
Yeah, and I suppose looking at those opportunities, looking at those, I suppose, sort of mature assets. How do you kind of go about sort of tackling, you know, the challenges that those throw up?
I mean, what we're looking for in an asset is it won't be just a single field. We're looking for diversity and trying to identify sources of hidden value, maybe where there's been a discovery or a field that hasn't been developed. Maybe it's a series of fields that haven't actually had the full infill. Can we deploy technologies we've seen elsewhere? So we'll be filtering as we go through technical, above ground risks. So Angola, very stable, so that will be a tick. The subsurface, is the subsurface pretty simple? Can we see opportunities with there? What about the fluids? Are they going to be good as well? Technologies to deploy. And then finally, can we make an impact from an ESG perspective? So 305, we felt that we could make an impact by looking at some of the reducing of the emissions. That's also where we look at other assets as well. So multiple filters. So 305, I'll just use that as an example. It's multiple fields, so that gives us diversity. Huge STOIIP in place. So every 1% recovery factor is 30 million barrels. You've got multiple wells, almost 100 wells, so diversity there. So lots, and it's also low cost. So lots of ticks.
I mean, ESG is something that obviously has really kind of come to prominence in the last couple of years, and I think it's very telling that you've put such prominence on it. How do you kind of go about making, I suppose, the financial case for that? I mean, obviously, we can see that better ESG is obviously kind of better for people, better for the world, whatever. But in terms of sort of translating that into a sort of a direct commercial, deal, how do you make that work?
I mean, from an ESG perspective, if I step back a bit, I think the industry and my former companies, we've been doing the S and the G for a long, long time. It's something that at Tullow we pride ourselves, whether we're in Ghana, Uganda, Kenya, or the other countries in Africa. The E side we were doing, but over the last particularly 3 or 4 years, the C element of E has dominated. So looking forward, you're looking at the asset of how do we actually improve the asset from an emissions. From a commercial perspective, flaring gas just doesn't make sense commercially and environmentally. So if you can make that gas work for you in different ways, so for instance, artificial lift, which will increase the production, lower the OPEX, the gas going into an export pipeline, which could then be used, gas to power onshore, providing energy to the communities. So I look at it as we're reducing the emissions or improving the environmental profile. It's the right thing to do, but also you can make it makes sense commercially as well.